Started. I make it 2 o'clock. Welcome to our audience and welcome to our webinar this afternoon, which is all about Get Set for 2021. I'm delighted to be joined by Adrian, Roux, partner here at WMT, who's going to deliver this webinar. Presentation will take about 30 minutes and we'll then stop and take any questions that you might have for Adrian at the end of the session. On your Zoom toolbar, you'll see the option for Q&A. If you click on that, you'll be able to put any questions you might have to Adrian into that chat box, and we will attempt to answer as many of those live as we can before the end of the session today. So I'll see you back for questions. We are recording this webinar as well, and it will be made available on the website tomorrow. But in the meantime, let me hand over to Adrian and I'll see you back for questions. Over to you.
Thanks, Jo, and good afternoon to everybody. It's never been more important to have up-to-date, accurate, meaningful financial information. And during the next 30 minutes or so, I'll briefly cover some subjects that regularly crop up. Each of these is a topic in its own right. So if there's interest, we can do further sessions on any of them. 2020 was a year of disruption and a very unusual year for most people, and this is obviously continuing to 2021 with many UK businesses facing some significant challenges. These include the national lockdown, which continues, although there does seem to be light at the end of the tunnel now. And we've got the effects of Brexit, which are still probably to filter through. Not entirely clear yet how they're going to manifest themselves, but they'll become clear as time goes on. We've got the legacy or the leftover effects of the cash flow and financial implications of 2020, and that's coming into 2021. And generally speaking, the world economy is probably a bit weaker than it has been previously, although that's a bit regional, so difficult to know again how that will affect us in the UK. It does highlight that planning ahead and good financial information will be crucial for businesses to meet these challenges. So the 4 topics that we're going to have a look at this afternoon are real-time accounting data and its relationship with cloud accounting, management accounts and why they're important, plus the benefits of forecasts when you're planning for the future, and lastly, why every business should know and monitor its KPIs. So real-time data and cloud accounting, they're quite linked together really, and this has become more so over the last 10 years or so. We've got a rapidly changing world, and it's very much reflected in financial technology, in particular cloud accounting. So over the last 10 years, cloud accounting has really gathered momentum, and for new small and medium-sized businesses, it's probably now the go-to option for their accounting. During that last 10 years at WMT, we've certainly noticed a big change in the kind of accounting systems that our clients use, and we've helped with the clients that we've helped, probably 90% of what our clients now use is cloud accounting. So that's predominantly the small and medium-sized businesses. The larger businesses maybe have more bespoke setups that are relevant for their particular industry. So what are the benefits of cloud accounting? In particular, it's very accessible. So it's an anytime, anywhere solution. So anywhere you've got internet connection, then you can access your data. Coupled with that, it's automatically backed up because it's online. It's just constantly being backed up. So never need to worry about actually setting the backup or taking backups off site or anything like that. It's always backed up. Those are things that make the accessibility particularly good. You then have daily bank feeds for the majority of these, so that you can access your bank information, bank transaction information, and that will pull in every day the payments and receipts from your bank account. Upgrades, they're done behind the scenes, so You don't need to worry about installing them, downloading a file from the internet or anything like that. They are just automatically done, normally during the quieter hours, when there may be a very brief interruption, but they'll just be done. And you'll always be on the latest version of whatever software it is with these solutions. Real-time collaboration with advisors. That means because you're up to date, you can share that up-to-date information with your advisors, typically accountants or tax advisors, and makes that process so much easier. And you've also opened up a world of other applications which will link with the core accounting system. So most of these cloud accounting solutions have what's called an open API. So the connected apps can link in and either push or pull data, or in some cases do it both ways. The market leaders in this side are probably Xero and QuickBooks. Xero certainly has been pushing everybody since it came on the scene. QuickBooks is a significant player in that market as well. Sage exists there as well, but they really haven't quite become as flexible or as developed as the other two at the moment, although they are continuously trying to catch up. If we look at Xero as an example, this is just shows the kind of apps that will link into it. So for example, you've got till systems and EPOS, where no longer do you have to take the data from your till system, either manually input it into the accounting software or use some sort of bridge via a spreadsheet or a similar link like that. They now directly link so that the data can be pulled across from a till system, or if you've got an e-commerce site, that data will be pulled in as well, so that again you can have that information at your fingertips in the bookkeeping software. If you run a service industry, it's things like time recording, so timesheets and the details for contracts can be all stored in there and linked through as well, so you can generate the sales invoices. Sometimes in the more advanced time systems, you can generate the sales invoice in the time system and it will then automatically sync with Xero. In the more basic ones, it may be that you've just got a time system that links across. One that we've seen to be particularly popular, probably because of the time savings that it brings, is supplier invoice processing. So typically these will, you send invoices over to the app. So this can be in batches of 10, 20, 30 or multiple batch size of PDFs of invoices, and the app extracts all the data from the invoice. That would be things like the supplier name, the date, the value, and in the more sophisticated ones, all of the narrative from the invoice as well. They can also split them out and into different departments if necessary, and also record the VAT. So this is a particularly good time saving. So the data input of having to key in information from supplier invoices has largely disappeared. The accuracy rates are very, very high now, probably something like 99%. So it then tees up the invoice in the accounting software, ready for you to do the final stages with it. This means then that you've got the cloud accounting facilitating real-time accounting. So as I said a minute ago, you've got 24-hour access to data anywhere in the world, and it can be updated daily. So what we're seeing as a result of this is that weekly and daily processing is now the norm, and automation helps speed that up. So it also means that when you get to the end of the month-end routines can be accelerated because a lot of the work has already been done. So if you've got a well-organized system, that month-end routine can be reduced to maybe a day or a couple of days, rather than in the past it might have been a week or 2 weeks or even 3 weeks. This is also leading to a change of emphasis in the way we work with our clients, that more people are saying, well, can we have monthly, bi-monthly or quarterly management accounts? to supplement the information that we're getting from our sales or whatever system that we use to manage our business. And there's a move away from then the reliance on the annual accounts, which are still necessary, but are going to just follow on as a byproduct at the end of the year and a necessity for Companies House and the tax authorities. So much more moving to an emphasis of seeing the information as and when it's relevant. Particularly useful if business needs outside finance. So it means that this information is readily available, and because it quickly speeds up the process, this can reassure banks, other lenders and investors, and it gives them the confidence. Also means that if there's any changes, you can quickly see the trends or the changes and react. Having that information early means you can react early. In the past, sometimes this delay could actually be the difference between being able to make an informed, quick decision, or actually being so far behind the curve that by the time the information was available, it was almost too late to do anything, or the impact of it would be significantly reduced. So it's just really, it gives that peace of mind and confidence that you're acting on the latest up-to-date information of your business finances. If you're thinking about changing, so you may be on an old PC-based system or something that you're not sure whether it's actually suiting your needs, your current needs, there are plenty of options out there. I think the first thing to do is compare what you have with what's available. There isn't a need to change for the sake of it. Sometimes what people have is actually perfectly good, and it may be that the publicity out there gives the impression that the alternatives might be better, but that's not always the case. So it's best to spend a few minutes or hours doing the research and just checking whether you will get some benefits from it. Coupled with that, you need to define the objectives of what it is that you want from your accounting system. And it may be that your accounting system is quite capable and delivers what you need, but it may not have the connectivity with the other apps that are available that will enhance other aspects of your business. So it's one that has to be looked at in the round, and seeing what the overall outcomes and benefits of changing might be. As with any investment, it's best to compare the benefits and also look at the costs. Sometimes there's the direct costs of new software, but then there's the indirect costs of training and any time that it might take for people to familiarize themselves. One of the advantages of many of the newer systems is that to get up and running with the core features is actually very straightforward. So hopefully the downtime and the implementation time is quite minimal. We will suggest that if somebody is starting with a new system, and it may be that they've identified some apps that they want to connect, that start with the core and the middle, and make sure that that's up and running and working as expected before going into the next stages. Sometimes people try and do it all in one go, and it can be a bit more complicated then, and lead to a bit more frustration if things aren't working straight away. As with a lot of things, there's a huge amount of information on the internet. Some of it contradicts other information, and if you're entering into this, you're likely to be doing it for the first time. So it can be useful to seek advice from those that have actually been through the process before, and can help demystify some of the questions that you may have, and also shortcut some of the processes to the selection and also the implementation. So if you've got the accounting system, then you should be able to get the management accounts. These are often underutilized by many smaller companies or smaller businesses. Many business owners make some use of basic financial reports to get an idea of the financial health of their business, but there's not that many that necessarily use the detailed information, maybe because they haven't got that capability in their software, or they just haven't accessed it if it does exist there. They do, provide a vital business insight, so they should be seen in conjunction with more frequent KPIs. So quite often management accounts will be done on a monthly basis, and the KPIs will be done on a more frequent basis. So to effectively run a business, you need both. They do nicely complement each other. The management accounts can be used to monitor if you've got problems in the business. So hopefully that won't be the case, but if you do, and sometimes they're masked because you could have your sales performing as expected, but there may be another problem somewhere where, for example, the costs are increasing, which on an individual invoice basis you don't notice, and it's only when you get to prepare some management accounts that you notice your gross profit percentage is decreasing. So they are a very useful way of identifying those kind of things. Similarly, if you've got opportunities for growth and investment, they're a good way of monitoring that and checking that if you've set up something new, or you've got a new part of the business, that investment is delivering the results that you hope it would. It's becoming more common now for banks to want to see regular management accounts, especially if there's a significant amount of lending from a bank. So these will help with your finance, and being able to show regular management accounts will help you get the finance, and then also help the bank, help you keep in touch with the bank that you are delivering on the expectations that may have been shared with them during that process. What does a management accounting report look like, and why they're important? This, first of all, for any business, profitability, that's got to be the number one thing. So it should show whether you're profitable or not, and hopefully identify aspects that are more profitable than others, or if you have particular areas that maybe aren't performing to the level that you would hope. Also show the assets and liabilities. These are on the balance sheet, which is not always looked at as much as it should be, but it will be the things that are relevant to your business. So it's what's there to be able to understand the business performance over a previous month or quarter. Also on the balance sheet would be information about your receivables and payables. So that's if you're an industry or business that gives credit, so you issue sales invoices to your customers, then you have data about the invoices that are unpaid, and equally on the other side of the coin, you'll have details about the amounts you owe to your suppliers, the values in total, and the timing of when they're due for payment. They should also give an overview of your cash flow. That may just be a simple in and out summary, or it may be details of the sources of the inflows and outflows, with the actual source of them being from debtors or payments out to creditors. I think, again, an area which is not always done in as much detail as it could be is reporting against budgets and targets. Having data that shows actuals is great, but if you don't have a target, you don't really know the context of what you're reporting. So being able to set a budget or a target for the coming year and then monitor your performance against that will give you a good idea of whether you're achieving what you set out to achieve. So hopefully you might exceed it, in which case you may need to re-budget, or if you're not exceeding it, then it will give you the impetus to start looking into why that may not be the case. The other thing is trends and variances. If you have monthly reporting and you show all of the figures for each month against each other's, then you'll be able to spot any trends in sales or expenses over the period of time. So if you've got 12 months of data, 1 month against each other, then, for example, you might look at the utilities bills and see that there's an increase in that expense heading, which again will give you the opportunity to look further into that and see if there's an obvious explanation, or whether there is something happening that you weren't aware of. It may just be a price increase that had crept through that you didn't notice. And also connected to that is the opportunities for cost savings, because you can look at the overall overheads in the context of your sales and gross profit and identify what net profit you want, and then have a look at the overheads and see whether each of them can justify their existence in the overall picture, and if there's anything that can be done to reduce those and increase the profitability. The contents and emphasis does vary between industries and businesses, but they do typically contain the following items. This would be a pretty good pack to produce. So an executive summary, that's something that you could just have a glance at, and it would give you the answer to the key questions. If we took a retailer as an example, you'd expect there to be some information about their sales, trends, comparison against the budget for the period in question, some information about the cost of sales, the admin expenses, maybe just in total, with commentary on any unusual items that might be skewing the overall figure, the profit again versus budget, quite often against the same period from the previous year, so that you can see how you're doing compared to the same period in the previous year. Gross profit percentage, just again to spot any trends there. Is the gross profit percentage going up or down? Does that fit in with the level of markup that you're applying to your stock? And then brief commentary on maybe the balance sheet with things like the bank balance, stock value, and short-term liabilities. That's things that maybe need to be paid out in the next month or two, just so that there's some visibility on any big payments that need to go out, such as VAT. Profit and loss account, which is the usual place that people focus on. That will have the sales and expenses in it, and profitability again against target, budget, and maybe same period of the previous year. And balance sheet, look, it doesn't contain lots of information in there, so just things like the liabilities of the business, PAYE, VAT, those kind of things. So understanding what expenditure is coming up can be very critical as well. Cash summary, so that's really just going to be how much money in the bank. Aged receivables and aged payables. Aged receivables, for anybody who's providing credit to their customers, very important to keep an eye on that, mainly to prevent any debts becoming a problem before that happens. So identifying any trends. So if you have, say, debtor days, 45 debtor days, and that's your norm, then if you compare that month by month and see that the time that people are starting to spend you is stretching to maybe 50 or 55, then that's a prompt to look into the reasons behind that. Is it that just that customers have started taking longer to pay, or is there a more deep-rooted problem to do with the product or service that you're selling, that there's more queries, so the customers are complaining more, and that's why they're not paying so quickly. Setting targets as well, so you may have an initiative to improve debtor days and collect cash in a bit more quickly. So having that information to see whether that project is delivering what you're aiming for can be reported back in this. Age payables, excuse me, age payables. So this is the payments to suppliers. Typically here, you'd want to make sure that it reflects the company policy. So for example, if the company policy is to pay suppliers in the month after the date of invoice, then the days credit should reflect that, probably around 45, something like that. And again, look for any trends to see if perhaps things aren't being applied as consistently as they should be. Most cloud-based accounting software such as Xero and QuickBooks also allow you to incorporate a wide range of other information. So you've got things like departmental analysis, project profitability, graphical representation, as well as the numbers. There's quite a lot of flexibility, and also then you can add on some of these other apps which might give you some more pertinent information to particular sections. And so really the management account itself, they having got that information and compared it to targets or budgets, you might want to modify budgets as a result of that information, give you areas to focus on to improve profitability or manage costs better, and then change your plans for the future and maybe revisit those periodically. So management accounts are mainly looking backward, whereas forecasting is going to be looking to the future. To manage your cash flow effectively, you need to understand the likely outcomes of different scenarios. Driving that in most businesses will be the top line of sales, but expenses and capital outflows can have a significant effect on that, so they all need to be looked at together. In looking at the forecasting, is predicting sales performance, and that would be where you would start normally, and understanding the drivers of sales and what things might affect whether sales go up, down, prices stay the same, volumes might go up or down and fluctuate with that as well. Add to that is the estimate of costs and spend expectations. So that's linking anything, so the expenditure that you've got to the sales or the overheads of the business. And then the next stage after that will be to work out the timing of your payments and receipts, which normally there will be a lag behind that. If you're a retailer, the sale happens on the cash comes in the same day as the sale, or may only be a couple of days delay while the credit card is processed. But in other industries, the credit delay may add in 30, 60, or even 90 days delay before you receive the cash on a particular sale. So all of these, what can look like a profitable business sometimes can end up being cash flow negative at times due to these delays. Many businesses will look to compile cash flow forecasts for different ranges, so that they understand the short term and the medium term, and in some cases, if there's a new investment or there's new funding and they want to understand what the implications of that will be, there might be a 1 year or 2 year forecast. Obviously, the longer the forecast is in the future, the greater the likelihood that it may not be as accurate. Many businesses look at the 30-day one just to understand that, make sure they've got enough money coming in to pay any creditors that are due in that particular time. So it's particularly important to understand the peaks and troughs, because sometimes the trend of cash flow can look positive, but there may be times due to, say, for when the rent is paid out, which might be quarterly, or the VAT, which is also quarterly, which creates troughs. And there may be other times where, if you've got cyclical sales, where you have peaks, and it's making sure that by identifying those, if there are troughs that maybe need bank overdraft facility or some longer term finance, that's in place before it happens, rather than it becoming apparent too close to the time. And the other thing which has particularly been brought home over the last 12 months is having a sensible cash float that will cover you if there's something completely unexpected that has a significant effect on the business. This very much varies from business to business, but coming up with a sensible amount that feels right is a good start. Preparing a cash flow forecast Most comprehensive forecasts will include what's called a three-way forecast. This is a profit and loss, a cash flow, and a balance sheet. They tend to be more complex because of this, and some people might just focus on the profit and loss, or maybe the cash flow, and then not look at the balance sheet. But a good comprehensive one would include all aspects of that. Usual to start with sales, although they can be a bit more difficult to predict, and the estimate of how much is to sell in the future. Normally break it down by month. Previous year's sales figures can be a good starting point, as they usually show trends or seasonal variations. But as I mentioned previously, it's understanding the things that affect sales and making sure that they're factored in to the forecast, and maybe doing a couple of alternatives based upon different scenarios and different outcomes. If you've got new products or services being launched, that may have an impact. There may be costs up front, which will take some time to generate revenue that will actually come back. There may also be your cost of sales that may have direct links to sales. So that helps when linking them up and understanding that relationships. After that, we then add in the overheads, which tend to be more straightforward for most businesses and easier to quantify. And then things like payroll costs, VAT, other one-off costs such as buying assets or other investments that are necessary to generate the income in the future. The main thing of these is, once you've got it, is to keep it updated regularly, so that you can keep track of any changes and things that don't happen quite as expected, which inevitably there will be some of those. There's quite a variety of software out there that can now help with short and long term, and some of these link into the cloud accounting software like Xero and QuickBooks, so it does give you a starting point. If you've got up-to-date information in that software, then you can use that as a platform to do the cash flow in another linked app. It's also getting quite sophisticated, so there's some out there now which use artificial intelligence to predict sales receipts. So what that will do is we'll look at the patterns of customer payments over a period of time, and instead of you having to put in a prediction of, say, 30 days or 45 or 60 days as to when the customer will pay, the software automatically calculates that from the previous history of a customer payment. And also they will alert you if a customer doesn't pay when it expects them to pay. Complementing what we've been talking about is KPIs. These are key performance indicators. Most businesses have a handful of measures that show whether they are achieving what's necessary for success. These very much vary from business to business because they will be specific to how you operate. So the KPIs that McDonald's operates with will be completely different to the KPIs that a car manufacturer would operate with, or an accountancy firm would operate with. So it's about understanding what are the things that are crucial to the success of your business, and having that information available on a regular basis so that you can check that things are going as expected. As an example, for a KPI dashboard, which you want to keep quite simple and just a handful of key data. A restaurant might want to know how many covers they have each day compared to target, what the average customer spend is, what the split between food and beverages, what their top 2 or 3 best-selling dishes and drinks are. And then having that data each day will give them an idea of what's going on. And then weekly, they may add to that by including labour and the direct costs of food and drink, so that they've got the gross profit percentage for the end of the week, and to check that that's in line with as expected. Revenue trends are going to be crucial. So measuring those by things like each customer or the service, or if you sell a product, or maybe by employee or salesperson. So a gym that runs classes would want to know what the revenue per member is, what the average class attendance is, what the customer retention rate is, and the average daily attendance. All of those pieces of information will give them an insight as to whether things are going in the right way. And if, for example, the average class attendance starts dropping, then they can look into the reasons for that and then see what they can do to turn that round. There may in some industries be a relationship between different categories. So you might have a relationship between sales and some expenses. So an online service would probably have a direct relationship between sales and packaging costs, sales and credit card costs, or sales and advertising costs. So keeping track of those would make sure that things like packaging is being used appropriately and efficiently. Credit card costs, if that relationship starts to break, then has the credit card cost gone up for some reason? Similarly, the return on advertising costs, if the advertising cost proportion to sales goes up, has something gone wrong? Is the advertising not generating the sales it used to, or some inefficiency crept in there? Also, cash flow, crucial for any business. So having some KPIs that may be as simple as daily or weekly inflows and outflows, just monitoring those against target to make sure that they're happening as expected. And lastly, we've got working capital. That normally means things like current assets less current liabilities. So for most businesses, the current assets will be stock or work in progress, money in the bank, and debtors, so money that customers owe. The current liabilities will be what's owed to the suppliers, and then you have VAT, PAYE, wages due to people, that sort of thing. So checking that those are working within the parameters that you expect. There's something called the current asset ratio, which will show that if you divide your current assets by your current liabilities, and the ratio is somewhere between 1.2 and 2, then that means the liquidity of the business should be okay. Obviously, it does vary a little bit from industry to industry, but it's a good indicator of that things are in a positive position. So that has covered the 4 main items that we wanted to touch on. For anybody who's thinking of looking at their prices in the next month or 2 or week or so, there's a matrix here which may be of interest, which shows some interesting relationships, and I'll just spend a moment or 2 on that, just in case it's relevant to anybody. This shows, and there's another slide which will show a similar situation for a decrease in price. So along the top of the matrix here, it shows your present margin. So that's the gross profit percentage, which would be the profit that you earn divided by your sales. So if you're operating at a 30% margin and you were to increase your price by 10%, you could reduce your sales volume by 25% and you would still make the same gross profit. So some of these figures end up being quite surprising, the amounts that you can, with relatively small prices, changes in prices, how significant the change in volume can be, completely affected by what the margin is. So the greater the margin, the smaller the effect over here. And equally, if your present margin is 30% and you reduce your price by 10%, which is not a big reduction for a lot of people, then it shows what the increase in volume has to be to generate the same amount of gross profit. So I hope that's useful. And in summary, I think the main thing is to set clear goals which are measurable, build a strategy to achieve those goals, establish the KPIs or review your KPIs to make sure you can monitor the progress against those goals, and then have some regular financial reporting which will verify your financial targets are being met. And as far as possible, be flexible and agile. The last year has shown that things aren't always as expected. Probably for most people, much more significant changes over the last year than anyone could have predicted. But even without those sort of changes, if you do identify something that is not happening as expected, it's being flexible enough and agile enough to adapt to the situation that you find yourself in. So just, we're available to help with any inquiries or go into any more detail on the subjects that I've just covered there. So I'll now hand you back to Joe, and thank you very much for everybody for listening.
Great, thanks very much, Adrian. We have had a couple of questions in which I'd just like to field out to you, and for everybody else, if you've got any questions for Adrian, just use the Q&A panel now to put those forward. So I'll start with these, Adrian. One question in: which cloud accounting software would you recommend? I appreciate there's a choice. Is there one that you would favour over another?
I think they each have characteristics that might make them more suited to different businesses. So some of them are maybe more in tune with people who have less experience in bookkeeping and accounting, and others are maybe slightly more for the purists. But I think, as I mentioned, the QuickBooks, we use both, tend to use Xero a little bit, but they are both very good, and it would be difficult to separate the two. If somebody was saying, should I choose this one or that one, there may be some, it may come down to the apps that connect to them, because they don't connect to everything.
Okay, thank you. And another question, which is about bank feeds. So you mentioned bank feeds, putting the bank transactions into the accounting software. So does that mean that anyone with access to the software can make payments from the bank account?
In a nutshell, no. The bank feeds are a connection, a secure connection between the cloud accounting software and the bank, which only facilitates the transfer of the data between the bank and the accounting software. So it gets taken into the accounting software normally on a daily basis, and that's the only connectivity between the two. There is no access into the bank account from the accounting software. So there's because some of the cloud accounting software, they may have 4 or 5 users within a business, and one person may be dealing with the supplier ledger, another person dealing with the bank side of things. So those people have no access to the bank account. They might be able to see the transactions, but they can't actually initiate any payments or anything like that. So it's completely secure from that point of view. Okay,
all right. I've got time for one more, which is, can I use a spreadsheet to do a 3-way forecast?
Yes, you can, and in the past that was how most people did these kind of forecasts. Spreadsheet, they're good insofar as most people can use a spreadsheet, but they are quite risky because it's ever so easy to make a mistake, and to have a foolproof spreadsheet which doesn't have any mistakes in it, especially if it gets changed on a regular basis and it's quite complicated, is quite difficult to achieve. It also tends to be a lot of knowledge in the person who designed it, so if somebody else has to pick it up, that can be a bit of a struggle. Things have moved on a lot now, so in the past there was maybe only 1 or 2 forecasting software options available. There's now a good handful, some of them very, very complex, other ones less complex but very effective, and very sensibly priced, but maybe won't give the level of complexity that some businesses need, but they do link into the cloud accounting software, so can give some particularly short-term predictions of cash flows, little peaks and troughs that might happen over the next 30 or 60 days.
Okay, brilliant. All right, well, I'm conscious of time, Adrian, so thank you for that. Thank you for the presentation.
That's okay.
We will make a recording of this available, as I mentioned right at the start, available on the website shortly. And of course, if you've got any more questions or would like to make contact with Adrian to discuss your own requirements, here's the contact details. So email or call would be excellent, or visit the website. So again, thank you very much for attending, and we look forward to our next one. Thank you.
Okay. Oh, and just if anybody wants a copy of the pricing matrix, let me know. I can forward that on.
Brilliant. Thanks very much.
Thank you.